So, what is going on with the economy in 2026? I mean, it is sending some seriously mixed signals. On one hand, we keep hearing about resilient growth, but on the other, those whispers about a downturn are definitely getting louder. So, what's the real story? And maybe more importantly, what are you supposed to do about it? Today, we're going to break down the economic signals that are flashing red and put together a clear, actionable playbook for your finances.
All right, let's just jump right in with this pretty stark warning from Mark Zandi over at Moody's Analytics. This guy is one of the heavy hitters on Wall Street, and he's known for making some incredibly accurate and sometimes, pretty uncomfortable predictions. And what he's saying now has the markets on high alert. This quote cuts right to the chase. A single volatile thing, oil, could be the tipping point for the entire U.S. economy. So here's our game plan for the next few minutes. First, we're going to look at the immediate risks that are shaking up the economy. Then we'll dig a little deeper and uncover the warning signs that were kind of already there. After that, we'll connect to all those dots to what this actually feels like for you and your family. And then we'll get to the most important part, what you can actually do about all this.
Okay, let's start with that big picture. Why has this conversation about recession suddenly gotten so loud so fast? Well, it's because the economy got hit with some major outside shocks right at a moment when it was already a little shaky.
49%. That's the number. That is Mark Zandi's calculated probability of a U.S. recession. That's basically a coin toss, right? His whole argument is that the economy was already on unsteady ground, and these recent events have pushed it right up to that 50-50 line.
And this timeline shows you exactly how fast this all happened. A conflict kicks off, it sends these massive shockwaves through the energy markets, and boom, oil prices just skyrocket in a matter of weeks. And this isn't just about paying more for gas. Think of it like a tax on the entire global economy. It squeezes businesses and it hits all of us as consumers, bringing back those old fears of stagflation, that nasty mix of high inflation and a stagnant economy.
And Zandi is definitely not alone here. You might be thinking, is it just this one guy? Nope, not at all. While his 49% is on the high end, you can see here that the concern is spreading all over Wall Street. JP Morgan, Mohammed Al-Arian, they're at 35%. Even the firms that are usually more optimistic have seriously upped their odds. The bottom line is, this risk is now being taken very, very seriously.
But here's the thing. The oil shock isn't the whole story. It was like a punch to an economy that was already showing signs of slowing down. So to really get what's happening, we have to look past that one big event and check out the cracks that were already starting to form.
And this is the big one. A loss of 92,000 jobs in February. I mean, wow, that was a major shock. The market was actually expecting a gain of about 59,000 jobs. So to see a negative number this big is a huge red flag that the labor market, the thing that's been holding up the whole economy, is losing steam, and fast. And if you look a little closer, these losses weren't just in one weird area. We saw big drops in major sectors like healthcare and IT. So this wasn't just some statistical fluke, it points to a wider weakness, probably as companies are starting to feel the pinch of rising costs and are tightening their belts for a potential slowdown. And all of this fits into the bigger picture of a slowing economy. That weak jobs report came out right as we learned that economic growth had slowed way down. GDP in the last quarter of 2025 was revised down to just a sluggish 0.7%. To put that in perspective, it was 4.4% the quarter before. The engine was already sputtering before the oil shock even hit. Okay, so what does all this high-level data and talk about GDP actually mean for your wallet? This is where the story really shifts from Wall Street to Main Street, because all these trends are creating some very real financial pressure on families all across the country. There's actually a term for this that researchers are using, the structural affordability crisis. The basic idea is that even when the big headline numbers like GDP look okay, the real cost of things you absolutely have to buy, like housing, insurance, healthcare, is just quietly eating away at people's financial security. And this slide just perfectly captures that disconnect. The official data talks about a resilient economy, but what people are actually experiencing is what researchers call mental anchors. We don't really feel inflation as a percentage, right? We feel it when that sub sandwich you've bought for years for $5 suddenly costs $14. You feel it when your insurance bill all of a sudden looks like a second car payment. And get this squeeze is moving up the income ladder. This isn't just a problem for lower income folks anymore. For households earning between $100,000 and $150,000 a year, the number of them living paycheck to paycheck by necessity, meaning not by choice, doubled in 2025. It's now almost a quarter of them. That is a really alarming sign of just how widespread this financial strain is. So that leads to this kind of a weird idea, right? They're calling it the resilience paradox. When we see reports that consumer spending is strong, our first thought is, oh, great, the economy's healthy. But what this research is saying is that it's often the exact opposite. It's a sign of endurance. People are burning through their savings and stretching their budgets just to cover the higher cost of everything.
Okay, so that's the diagnosis. The risks are clear, the impact on all of us is real. So now let's pivot to what really matters, the strategy. How do you actually navigate this environment as an investor? You know that feeling, right? The market gets all choppy and crazy, and your first gut instinct is just, get me out. But this data from Charles Schwab is so powerful because it shows why that can be such a dangerous move. If you had stayed fully invested in the S&P 500, you'd have seen an 11% return each year over 2 decades. But if you tried to time the market and missed just the 10 best days, your return plummets to 6.6%. The key is that the bounce backs are often sharp and totally unexpected, and you literally have to be in the market to catch them.
And look, who better to listen to on this than the man himself, Warren Buffett? His whole philosophy is beautifully simple. Downturns aren't something to be afraid of. They're an opportunity. It's a chance to buy into great companies when they're basically on sale. It's all about shifting your mindset from that short-term fear to long-term opportunity. All right, let's bring it all home with our final section, your personal financial playbook. These are clear, simple steps you can take right now to make your own financial plan stronger, no matter what the economy decides to do next.
Okay, so here are the 4 big pillars. First, build up your cash. Why? Because having 3 to 6 months of expenses saved up means you'll never be forced to sell your investments at the worst possible time just to pay bills. Second, like we just saw, stay invested so you can capture that eventual recovery. Third, get aggressive with high-interest debt, like credit cards. Freeing up that cash flow is a huge defensive move. And fourth, notice the word make strategic tweaks, not huge, drastic changes. So what does a strategic tweak actually look like in real life? Well, it means tilting your strategy, not throwing it out. It means favoring those high-quality companies with strong balance sheets that can weather a storm. You know, the ones with low debt and steady cash flow. You might also think about those historically defensive sectors, like companies that sell things people need no matter what, like food or healthcare. But most importantly, stick to your core plan, your asset allocation, and make sure you stay properly diversified. And that really brings us to the final, and I think the most important question. Economic seasons are always going to change. We'll have good times, we'll have recessions. The goal isn't to perfectly predict what's coming next week, but to build a strong financial plan that's designed to last through the entire cycle. So take a hard look at your own plan. Is it built for whatever comes next?